conventional monetary policy we are into. Today our the item number 1, open market operations. Open market operations. See, RBI has its Arjuna's eye on liquidity management, price stability, all else will be a consequence of this. These are the primary goals. Price stability, all else is implied. You know, so why does the RBI manage the SLR? Same, ABCD are there, but CRR, REPO, SDF, MSF, everything that the RBI does, it does for price stability. Implied in that is, you know, all other goals. And so, OMOs come under the same umbrella, price stability. What do you do here? In the LAF, bring me your government security. Yeah, here it is, government security. How much is it worth? 100 rupees. Take this 75. Come back tomorrow. Give me the 75. So what are you doing with this government security that you have purchased? You are keeping it with me. You are keeping it with me as a collateral. Whereas another choice also you have. You can sell it to me. Sell. Or I can produce government security and sell it to you. So in the open market operations, there is selling. I sell a government security, take your cash. Tomorrow, overnight, you sell your government security and take cash if you require cash or if you see some profit. So, selling and buying of government securities is covered by OMO. When do I sell a security? If I see a lot of money sloshing around, I want to absorb the excess, so I sell a government security. When do I buy a government security? When there is shortage of liquidity in the market, I buy a government security, put cash, take the paper. So, buying and selling of government securities by the RBI in order to manage the liquidity and all else is called the OMO. How do I get the government securities? That's my job. To produce the government security for, that's my job. And how do I get the money? RBI is a monetary policy authority. To print is its birthright. So there are some procedures for that. You print money, buy security. Buy security. So what do you have? Paper. What does the economy have? Cash. If there is excess, you produce the paper, put the paper, take the cash. These are the classical open market operations that the RBI does for its objectives, essentially liquidity management. You know, when you say liquidity management today, liquidity management is directly linked to price stability. Tomorrow, liquidity management could be directly linked to either dampening growth or promotion of growth. So, liquidity management could be linked to various goals depending upon the situation of the economy. You know, it changes from time to time. So that's OMO. I've got a lovely graphic for you, Dharmendra ji. Please allow us to get enlightened. OMOs, please. Read every word and see if you have digested it. Exam is going to center around this, directly, indirectly. Understanding? You picking up? Yeah. You know all this. I'm trying to formalize it and establish interconnections.
How does liquid attachment facility differ from open mass operation? Liquid attachment facility.
You tell me. You give me the answer because I began my lecture with that. I used this also. Yeah. So you please tell me. I'm sure you can answer me. If you can take 10 seconds, I'm sure you can answer that. If not 10, 15 seconds? Yeah. Can you now? You see? So don't jump into asking. Ask yourself. You are the finest guru to yourself. I am here just to push you in the right direction. You are the finest guru. You got the answer now? In one, sir, you keep it and give me the money. Tomorrow I'll come back and return the money and take this back. LAF. And in OMO, sir, I'm selling this. This is worth 50. How much will you give me? Whatever you give me. So outright buying and selling. Buys, sells. When do you buy the government security? When you want to put cash there when there is shortage, liquidity crunch. When do you want to sell a government security? When there is excessive money inflating the economy and you want to sell a government security and absorb the excess cash. Very, very simple. Isn't it? Yeah. Please understand. Ask yourself first. I challenge you, you can answer it. Don't think you can't answer. You can answer. Ultimately, I'm always here. You know. So first you struggle a bit for a few seconds. Oh, okay. So there is more cash, rates will come down. Less cash, rates will go up. Your job is to adjust the amount of liquidity based upon the amount of liquidity. Rates will dance. More liquidity, less liquidity, more. So liquidity and interest rates are inversely related. Each one of the lines I have spoken is a potential entry into the preliminary examination. You know, make your mind work on these lines. This is big. Let me talk first and then they will see. This is super. Okay. So, what have we learnt? We have learnt that another technique that the RBI has, another instrument process that the RBI has for liquidity management in the economy in order to impact the prices, in order to impact the interest rates, they are all interlinked, is this OMO. Now, I am going to take you slightly away to explain to you an expanded form of OMO. Listen to me very carefully. We are going into the foreign currency zone. Now, so India is an open economy, globalized. We are everywhere. Everyone is here, into the stock market, into the production economy. They lend to the government, they lend to the corporates, they buy our stocks, they invest in the economy for production of goods and services. They lend to us, in multiple forms. So yes, and we export and import and we travel. Now, we need foreign currency because much of our dealings with the world are in foreign currency, because rupee does not have that global value. Nobody accepts rupee except in Nepal, Bhutan. Nobody accepts rupee. Why? We are not an international currency in that sense. Why? You cannot, the reason is that, why is it that nobody keeps? For a currency to acquire global reserve currency value, it should be a large economy. We are large. It should be a performing economy. We are performing. It should have a lot of exports. We don't have. 2% of merchandise, physical goods of the world exports, India. So 2% you are exporting, people are buying. If you are exporting 10% or so, then you see people will keep rupee so that when I am importing from India, I can pay in rupee. And then once I can pay in rupee for what I am importing from India, another country also will accept rupees because they are also importing from India. So an exporting economy generally has a global reserve currency status. People don't stock Indian rupee because Indian rupee can go anywhere. They don't stock, and especially when they have dollar and so on, why will they have Indian rupee? Your confidence in the rupee is not high. Why? Because your global integration is not high. The, exports I told you, etc., etc. Now, so we need foreign currency. We have to pay for our imports in foreign currency, and nobody accepts us if we say we'll pay in rupee because they have no value for rupee. We are of course internationalizing now. I'll come to that later. So we need foreign currency for paying for our imports and stuff. So how do you get the foreign currency? People will give you loan if you have some earnings of foreign currency. If you are exporting and you are getting something, somebody will give you a little bit of dollar so that, see, I'm exporting, I'm earning dollar, I'll repay you. See, I have a stock market. My companies are global companies, Reliance and TCS. You please buy their shares, you please come. Okay, they'll come, they'll bring dollars. So, if your companies are doing well, stock market is open, people will come invest. If you have an economy that is doing well, liberalized economy, you want them to come invest in the economy, they will. So you try a lot of policies in order to acquire foreign currency, because foreign currency is required for you to import. You are not exporting enough. You are exporting 100, but you are importing 100 and say 20. $20 gap is there. And all, there are problems there. I don't want to go into. Therefore, you require foreign currency and you opened up your economy to earn the foreign currency. I'll tell you what happens in a highly simplified form. So someone comes, let us say a traveler comes. He is coming to, this is 2036, let's say Ahmedabad Olympics, India is hosting. Lot of people come and they'll bring dollars, euros, whatever foreign currency. I'll call dollar foreign currency. When I say dollar, it means foreign currency. So they'll get foreign currency into the country. And where do they go? They go to a forex dealer, give a dollar, $100, and then take rupees because they want to go around India, not just Olympics, they want to go around it. So the forex dealer, SBI Forex Wing, has $100 and they have given their rupees to him. They have taken his dollars. SBI says, I need only $10. The other $90 I'll sell because that will fetch me rupee, and rupee is my mainstay. Dollar is on the sidelines, fringe. So a lot of people are going to buy the dollar from the forex dealer SBI. Why? Indian Oil wants dollar so that it can import oil. And somebody wants dollar, he can go to Ireland to study. Somebody wants dollar, he would like to invest in American securities. So a lot of work we have with dollar. RBI also wants dollars. So RBI wants dollars like anyone else, like you, like me, like someone else. We are all in the forex market. Some seller is there, buyer is there. RBI is a buyer. So RBI prints rupees and takes it to the market. Asks the forex dealer, I want to buy the dollar. You know, if I can push the guy, he has to sell only to me. But I don't want to do it. I want to be among the buyers. So let's go. You are there, I'm the RBI, you are Indian Oil, and somebody else is Infosys, and still somebody else is whoever. We are all there, we have gone there. $90 are up for purchase. I want to purchase, you want to purchase, what's the rate? 83 rupee 25 paisa. I'm game. So I will give that much of money. I printed, I can print, and I've given him 83 and whatever. I took the dollar from him, bought the dollar. I bought the dollar. You guys also have bought the dollar. Maybe I bought 70, you bought 10, you bought 5, you bought 5. We all bought the dollar, and you don't require so much. My appetite for dollar is bottomless. Because I'm the central bank, I need the dollar, I have a lot of work with the dollar, I need to stabilize my exchange rate and lend it to people so that they can do a lot of things. I need the world to know that they can come into my country, they can leave my country, there will never be a problem about leaving the country with dollars. How do I give them confidence? By holding, see. I've got $575 billion worth of foreign currency. That includes gold and stuff. So you come into my country, sir, I'm coming with $100 million. I'll be there for a while. When I want to go out, will you be able to give me 100 million? Here it is. So in order for a lot of work for the RBI to do, it requires foreign currency, macroeconomics, exchange rate, servicing the debt, allowing our travelers, financing imports, confidence building about the economy. So yes, I've got this. Now what did I do? I printed rupees. And I bought the dollar. So let me show it here. Print. Purchase dollar, print rupee. Purchase dollar. So, in my pocket there is the dollar. In the economy there are rupees. $1, $1 billion, $575 billion worth of rupee I have printed, put it into the economy, and The economy has no use for it. Somebody is coming into my country to produce steel or cement. Then this money is required in the economy. But somebody is coming to my country to visit my country, travel in my country. Someone is coming here to buy the Reliance shares. The correspondence between the need of the economy and the cash flowing in the economy, there is disconnect. There is cash, there is economy, more cash, economy is the same almost. Economy goes up by 1%, cash goes up by 10%. So there is a lot of cash in the economy. Dangerous condition. So RBI has to absorb the excess cash, rupee, because it will inflate this, that. So what does the RBI do? RBI starts market stabilization scheme. Market stabilization scheme. MWS. This is, we have just now come to the conclusion, this is the economy and this is the amount of rupee that you require, but this much of rupee there is, this is excess of rupee, it has to be absorbed by the RBI. Economy needs 10 rupees, 100 rupees are there, 90 rupees have to be absorbed. For that, RBI will print special securities, government securities, you name them special for some reason, produce them, sell it in the economy. You guys have cash, you don't need the cash, you want to park it somewhere. I won't let you have the cash. Why? It's going to inflate, it's going to destabilize. So take this government security, give me the cash, rupee, I'll give you the interest rate, 10-year, 5-year, whatever. You know, maybe a few months also, 91 day, 182 day, 364 day, 1 year, 5 year, 10 year, 20 year, you know all that. Take this paper, give me the cash, I'll give you interest. And just like a bond, that's what the government security is about. So here, what has the RBI done? You know, RBI has done the following. It has, you know, soaked the excess cash, one, paying the interest. Now, RBI doesn't pay the interest, Government of India pays. Because RBI has no interest in all this, it's doing for the country. That is what is called quasi-fiscal. Quasi-fiscal. See, repo, reverse repo, also RBI doesn't pay, but you don't have to go to the government. For the reverse repo, I'm paying a little bit. Repo, I'm earning a little bit. I'll arrange in such a way that I'll pay 1 rupee, I'll get 1.5 rupee, I'm sitting on profit. But then this is a mountain of an operation. $580 billion worth of rupees have to be taken away from the market, you know. That can't be handled by the normal operations of the RBI. It requires government intervention to pick up the interest outgo. Finally, I took the money from you. That money I'll pay you back. You give me the paper, but interest who's going to pay? Such huge amount, government will pay. Does the government use it? Now it is using. I'm lecturing in 2023. I was lecturing before COVID also. Before COVID, what was my, thrust? I was telling, see, here is the money. There is FRBM. Government can't borrow more than 3% of GDP, but this is quite a lot of money, and government borrows only a little bit. This is the amount you picked up, through your market stabilization. Government would require only this much because there is an FRBM. All this is the money that you have with yourself. You can't use it because if you lend it into the economy, it will inflate. Government doesn't want to take it because it can't take more than 3% of GDP as loan. So here is a lot of cash you are paying interest on, but you have no use for. I used to say this pre-COVID. After COVID, the government's appetite is once again bottomless. And so all this money the government is using. So I'm not sure if you can still use the term quasi-fiscal. It is fiscal now because you're borrowing for the government. Whatever you're borrowing, the excess cash, on lending to the government. So it's not that the government is not using but paying the interest, and so quasi-fiscal, all that. Leave it aside. So now you know the operation. Print rupee, buy dollar. Keep it, you have a lot of use for it. There's so much of cash that you printed and put it into the economy to buy dollar, so there's a lot of cash. And it's not good for the economy. Print special security. Sell to the guys who are holding the rupee and then take the rupee back. Keep it here. And then do what? Lend a little. There's a lot of calibration there to the government, etc., etc. So this is called the market stabilization scheme. And what's the difference between open market operation and market stabilization? Open market operation you do on an ongoing basis. This is the kind of cash it takes. This is the amount of securities you are dealing in. Market stabilization. You don't do it all the time. We are talking about it at a time when we are in the shadow of COVID. So it looks normal. But then this is the norm. This is an exception. This is MWS. This is OMO. Now when you see the table, the black table on the board, with the help of Dharmendra ji, you will be able to get 100% clarity on this. See? Now you please digest it. Eat it up if you like. The last one is missing. No, even more. Because this is important. Special is important. Special security is meant for a specific special purpose. They are government securities all right, but they are not used like the other government securities. They are meant for a specific operation, gigantic operation. Take your time. The buzzwords here would be here if you say ongoing, examiner is very, very happy. But before you say anything else, buying and selling, both are buying and selling. This is a smaller operation, ongoing operation, has no impact on the fisc. The government finances are not impacted. Here they are impacted. You know why? Government has to pick up the interest. So it's impacted. In the OMO, small operation, I pay, I charge. That cancels out. A little bit of profit I make. Here I am absorbing so much of cash, paying so much of interest. It's not in my normal jurisdiction. So this is the kind of money I can't, I won't, I don't have. So you pay me. I'll print and give you, but you pay me. You know the fiscal cost. Excess of liquidity, too much of liquidity. OMOs are for normal amounts of liquidity. There's avalanche of liquidity. How do you manage that? Only by MWS. Visibility is okay there? Are you straining your eye? There? Okay, thank you. Because all the effort that I put in to make the table so wonderful, full value. You know, the word should not be collateral. After all, collateral is pawning. Keep it and give me. Tomorrow I'm coming back to take it back. It's not collateral. It is, you know, the instrument. You should use the word instrument. What is the instrument? Here it is government security. Here it is special security. It can be bill. It can be bond. Bill is up to 364 days. Bond is 365 to perpetual. Today you got the monetary policy notes in your hands. You know, your comfort doubles. You know what is productivity? If somebody is there to guide you, you got the notes, then you double up on your productivity. Notes is not there, big words are being used. So now your productivity is, unlocked. You're okay with this? Can I switch off? Okay. So, open market operations we have done. The quantitative elements of the monetary policy have been rounded up. Quantitative. Now let us move to qualitative. Qualitative instruments. Qualitative instruments of monetary policy. So yesterday, as an introductory remark, I told you this is the market and 100 rupees, 100 becomes plus or minus, it is quantitative. 100 remains 100, but there is internal juggling. You call that qualitative. Qualitative, L-T. So this is qualitative, this 100 remains 100. But within 100, who gets how much? Real estate, exports, pharma. Who gets how much? Stock guys, small scale industries, small medium enterprises, micro, small, medium enterprises, MSMEs. Who gets how much? RBI can regulate that. The governor can tell you, you know, you're all commercial banks. I'm the governor. I can tell you, friends, you know, things are getting slightly dangerous. 2 aircraft carriers. And when Biden was there in Israel the day before, I think it was the day before, yeah, he said, anyone tries to mess up, he said something wonderfully, beautifully, don't. Because they are in a very pugnacious, belligerent mood. No one can come our way. We'll destroy them. You know, so RBI governor will tell you, you know, things are not hunky-dory. Prices, all that. Supply side could be hit. So, when you lend to the stock guys or the exporters, you know, charge them a little more, number one. If you are lending 100 rupees, keep aside 10 rupees of margin. To begin with, you are charging more, nobody will take. On top of that, for the 100 you are lending, you have to set aside 10 as the margin, which means you're getting interest for the 100, but you are effectively locking 110. So margin requirements can be costlier, rates are high, and if still you are going ahead, he is going to tell you, don't lend more than 150 rupees to that sector. Clamp down quantitatively. What are they? Selective, credit, control. Control by rate, control by quantity, control by margin requirements. That is why they are called selective credit controls. And that comes with a rule. Whereas today RBI governor, I'm in the class, I'm not able to watch, otherwise he's going to give a lecture. I'm sure he's going to talk about this thing in the West Asia. We call it West Asia, Americans call it Middle East. For us, Asia, West. For them, Middle East, colonial, imperial. So the point is, he's going to tell them, friends, go slow. So friends, go slow. There's nothing official about it. He is not quoting section 25. He's just telling you, friends, be cautious. Things can go wrong. You better be careful so that problems don't come up. What do you call this? You call this moral suasion. Moral suasion. Suasion means persuasion. I can make a rule, but you see, please understand, in your personal relations, be it your family, be it outside, there are shades and shades of relation. There are times when you are silent. Your silence speaks louder. There are times when you say, oh, and all that. So each one of these nuances has a definitive communication value. Just like that, RBI governor in a press conference, in a personal letter, or maybe he is wishing you happy Dashara. So in all this, he can guide you and your behavior on a persuasive, non-official basis. That's called moral suasion. After all, when the RBI governor says something, lakhs of crores of rupees are tied up to that statement. The color of his suit speaks, shirt speaks, smile of course speaks. So RBI governor is a special person. So when he is advising you, it has lots of policy value. He may say, friends, I'm not raising the rate, that doesn't mean that I'm accommodative, you take care, whatever. So that's called persuasion, moral suasion, selective credit controls. These are the techniques that the RBI has at its instruments that the RBI has at its disposal to regulate the money supply for A, B, C, D, E, F, G, H objectives. So that is one part of our discussion. Next comes, there are some other parts. I want to talk about a condition, an economic situation called liquidity trap. Liquidity trap. Liquidity trap is see, God forbid, economy has crashed. Economy has crashed, like post-Lehman or post-COVID. Factories have shut down. People are not working. They are all asked to, what they call furlough. That is, go home. You are on the rolls, but we won't pay you. Come back whenever, So, a lot of people are out of work. No demand. Factories shut down. Prices are falling along with growth. Growth is there, inflation is there. Growth is not there, inflation is not there. And so you are going towards 3%, 2%, 1%, 0%. Inflation is going towards zero. Next step is deflation. And this is the condition. So today, what did I say yesterday? What did I think of yesterday? I thought I'll buy it today. Yesterday it was 2 rupees and today it is 1 rupee 90 paisa. Tomorrow it will be 180. Day after it will. Nobody buys anything. Why? Prices are falling. I'll buy tomorrow. Nobody puts money in the bank. Why? Interest rates are 1%. Who is attracted? 1%. I'm not attracted. And everyone keeps cash with himself. Some people put it, not everyone. Some. Cash, keep it with yourself. Don't buy. When you don't buy, economy tumbles even more. After all, economy runs on you and I purchasing. If you don't purchase, the economy tumbles. It's tumbling. We are holding on to our cash. Banks are desperate to give credit. Rates are zero. Zero. Negative. I'll come to negative. Too much of cash there with them. RBI is telling them, take more cash, take more cash. Cash is there, rates are low, SLR is zero, CRR is zero, lend, but who is taking? See, RBI is effective in a functioning economy, a non-functioning economy. So my effectiveness is zero. Government should do something. What can the government do? Same thing, Keynesian. Borrow, spend, create jobs, create demand, and then bring the economy back into action. So the condition I had described to you is a classical liquidity trap. We are all trapped in liquidity. You guys got cash, don't want to spend. Banks have cash, they want to lend, they want to throw it away, literally. No one to take it, neither investor nor the consumer. Only guys will take, of course, the government and the Keynesian stimulus and all. So this is the liquidity trap. We are all trapped in liquidity, not purchasing anything, not keeping it in the bank also. Rates are very low and still not helping. Cash is plenty, still not helping. Demand is dead in the economy. This is called the liquidity trap, and RBI is utterly helpless like any other central bank. This is the liquidity trap. The agency that has to come in to help the economy revive is the government. Because the factories are closed and they are gone. We don't want to spend because we see worse conditions and we'll get it cheaper, number one. We are cautious, number two. Both ways, we don't want to spend. Factories are gone. We don't want to spend. No one to take the credit. Everything is paralyzed. The only agency that can help is the government. Keynesian stuff they have to do. Dharmendra ji, I made a super lovely graphic for you. Liquidity trap, yeah. And I think one more I made, or maybe not. Just see this. This has everything. And he may not ask you in the liquidity trap this. No. Understand this. He may not use the big word like liquidity trap. That term you can use in your main examination. The examiner gets floored with that, unless you are showing off. But then he is going to ask you the interlinkage among the concepts here. Interest rates, deflation, inflation, growth, central bank, fiscal authority, that is the government, etc. Take your time. No hurry. It will take about 2-3 minutes to digest. Trapped in liquidity. Banks are trapped in liquidity. We are trapped in liquidity. RBI is helpless. I'm taking you back to your 10th class days when you dreamt of understanding things simply. So this is simplicity at its best. I'm sure you'll agree with me. Not one big word. You know, where you have to use, but not to show off and complicate. Yeah.
Sir, non-traditional methods which have been written in rule of RBI.
Non-traditional. Here, I'll come to that. So, for liquidity trap is, you try to deal with it conventionally. You're not able to do it. If the government can step in and do it, that's okay. But government is also helpless. Then you jump in with your non-traditional stuff, which is, we are getting into that. Liquidity trap is the bridge between conventional, unconventional, non-traditional. We exhausted the traditional. And before you get into the non-traditional, unconventional, we need to cover the liquidity trap so that, the transition is smooth. So wrap this up, or one more minute you want to spend here, all connections you want to. We should keep a red light here after they have exhausted. It's clear. Can we? Yes. Okay. So now you have tried the traditional, but the problem is not going away. For example, post-COVID, two situations I can give examples. Lehman Brothers, $2,008 after that, till about say 12. They struck in September, they went bankrupt and a huge crisis opened up, 12. And of course, COVID-19, it lasted till about say 22, okay. 22, early 22. So, see, I will simplify to a point of not giving you the whole truth, but for the UPSC examination, you don't need more than that. American banks, European and Japanese also, American banks basically made in America, crisis, they lent to people who were not credit worthy because they had a lot of money. That money had to be lent. So catch hold of people who are not credit worthy, lend them, and so catch hold of 10 people. $100 each you lend them. How much have you lent? 1,000. And so you take their papers by this salary, this, that, date of birth, Aadhaar, all that, bank account, $1,000. This $1,000, you convert that into a security, tradable security. You sell this 1,000 rupees worth of securities to him. He says, okay, you sell me at $900. I will collect 1,000 from them. The 10, the difference is my interest. Okay, give me 900. Take the papers, collect. I wash my hands off. May not wash my hands off, but temporarily I'm out of it. If they don't give, I have to give all that. 900, lend it to 9 people. 100 each. Take the papers. Sell to this guy for 800. Take 800. You collect from them. So if all these guys are non-credit worthy, they'll never return the money. So all those papers that were bought, speculated, this, that, all of them became junk. Some of the finest of the banks put their money there. It turned out they became junk and the banks had no money to lend. My $100 in the bank, sir, where is it? No, we don't have. So, tens of millions of people, their money in the bank was washed out because banks, all sorts of things happened. So, these guys, what do they have? Paper. Paper that doesn't sell. It's not government security. Tradable securities created out of questionable loans, etc. So, here is Ben Bernanke, the guy who got the Nobel last year for economics, shared it with others. Here is Ben Bernanke. Here is the economy, flat economy, because of the sort of irrational lendings and all that. So Bernanke is watching. Economy was tumbling, stock market tumbling, no demand. Banks were going out, they were going bankrupt. So Bernanke, there was nothing he could learn from a textbook. What will the textbook say? Tell the government to do something, you are helpless. Then Bernanke thought, this is a historical. Textbooks only tell you about what happened in history, but this is something that's never happened in history. I need to do something original because this is a unique crisis. So Bernanke thought, let's get simple. Let's print money. These guys have paper. Never mind what kind of paper it is. They are all Americans after all. The money you lend to Americans. And Americans, if not today, tomorrow they'll be fine. Day after they'll be fine. So what are you in a hurry about? So what is it that you have? You've got the bad loan paper? Never mind. Give it to me. I'll give you cash. Start your normal banking operations. So in a quantitative easing, what you do is you print enormous amounts of money. With that you buy corporate and government securities from banks and others, and in the process you inject enormous amounts of money into the economy so that the economy is again back into the demand driven economy. There will be demand. You can lend money to people. The money of the people that got frozen because you went into all the bad loans, you got the money back, their money is back, and you can lend also to the new people. There is money, go to the market, purchase, revive the economy. So in this quantitative easing, something that is new is, earlier, take India, the central bank, RBI. RBI does not touch anything except government securities. SLR means government securities. Even government securities, not your food bond, fertilizer bond, oil bond. No, 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 nothing, nothing. Government securities, you know, which are, they go into this, consolidated and all that. Government securities produced by the RBI, sold for SLR eligibility and beyond. Only those securities RBI will buy. Even if you are Reliance or TCS in India today, today is the some 20th or 21st of October, till today. I don't know about this evening. Maybe it will change. I have no idea. So as of now, RBI buys and sells only government securities. It doesn't deal in corporate securities at all. Which is normally whether you do MSS or on a small scale you do OMO, what you do is deal in government securities. But then if you confine your dealings only to government securities, you can't come out of the crisis. So the Federal Reserve of America, their central bank, their RBI, thought, let us buy whatever paper they have, junk paper, let's buy. Because the idea is, why did they buy? There must be some reason. Something went wrong. They did yesterday what they should have done today. So it's okay, why punish them? Buy the paper, put money into their hands. So that is the quantitative easing. RBI did it in a limited scale. I'm coming to that. So this is quantitative easing. So now, what is the condition? Liquidity trap. You know, liquidity trap is, it has to do with economy structurally. But the post-Lehman and post-COVID crisis, post-Lehman I'm talking about, nothing wrong with the economy, just that the banks ran out of money, they lent to the bad guys and the bad loans are there and they are not monetizable and therefore they were flat and they just needed someone to buy the paper. So that's all the problem is. So quintessentially this is not liquidity trap. Banks ran out of cash because of the bad investment. Some went bankrupt. So, you know, that is, but then liquidity trap is there. In a liquidity trap, the question is not shortage of money. You haven't gone dry. It's just that the structure of the economy is such, the circumstances is such that there is no demand. So, quintessentially speaking, you know, quantitative easing you could try. Will it help? After all, 100 rupees are there with the banks. 1% is the interest rate. X is the demand. 1,000 rupees are there with the banks, quantitative easing. 0.5 is the interest. Definitely X plus is the demand. So you could try your luck with the quantitative easing also in order to inject more money unconventionally, huge quantities. After all, surely demand is also a function of the supply. You know, keep supplying, demand picks up. The signal is sent and the substance is also sent. So here you could try quantitative easing in a liquidity trap and check your luck. That is one unconventional. I hope you understood. If you haven't, I'm here. Ask me, you know, from all this. That is exam material. Now, it's very simple. Please, even for a split second, don't think It's tough. It's tough if it is made out to be tough. The way I taught ninth class stuff. Surely you're not ninth class kids. You've grown up. But still, the standard at which I pitched, ninth class. So that's quantitative easing. You know, if somebody asks you what is quantitative easing, lot of money printed by the central bank and supplied to the economy so that it creates its own demand and the economy comes back full stop. After that, you have no relation with him. You know, either he is applauding you or, you know, he is not worth your conversation anymore. So, next is quantitative easing we have done. We talk of unconventional. Negative interest rates. This is also unconventional. We've never seen. America never saw. Only Eurozone saw. What is this? We are seeing right now, we are seeing negative rates in India. I have 100 rupees. Inflation last month was 5 something. Last month. But the month before was 675. Next month could be higher because of the Gulf. So let's say inflation is 5.5. Annual average should be about 6. I don't think it's coming down, but the base was high. Say annual average is 5.75. I've got 100. Next year, my 100 will be worth 94.25. So inflation 5.75 annual. How much is the money I have? 100. So what will be its worth next year? 2024 October, it will be 94.25. Because inflation ate up my money. Now, I go to the bank, sir, I have 100. Okay, we'll give you 2.5, keep it in savings. Keep it in fixed, we'll give you 4.5. But I need the money. Keep it in savings. 2.5. I need the money. I want decent return. Savings. So, 2.5. I'll bargain. Sir, 2.5 is nothing. 275. Okay. So, 275 is the interest rate. Which means my money will be worth 97. Still 100 has become 97. Officially you are giving me 275. I am made to believe that 100 plus 275 is 102.75. I am in the positive territory as far as the value of the money of mine is concerned. But if you scratch it a little bit, you will realize what is the purchasing power of the 100 rupees? 97. So the negative interest rates, the difference between nominal and real, nominal is on paper, real is inflation adjusted. Nominal is the interest rate official, real is the inflation adjusted value of the money. From there you could derive your real interest. So real interest is minus 3%, I am in the negative territory. But if you tell the bank, tell the RBI, what are you talking? We are giving you 2.75. The rest is, your headache. So the central bank or the commercial bank, they are not charging you for keeping your money. They are in fact rewarding you for keeping your money. So as long as somebody is not charging you for keeping your money, that's not negative rate. Go to the European Union, not now. Not even, the Ukraine thing happened in Feb last calendar. I remember the last guys to raise the rate were the Eurozone guys. They did so, if I recall, everyone did by April, May. We started May. Americans started in April. UK started around April, May. Eurozone guys started in September, if I recall, or August. That's because growth was very crucial for them. They didn't want to kill growth by raising the rate. Till then, you know what they were having? Come, I'm a bank, you come. Give me your 100. Come after 1 year. Take 99 rupees. Which means I'm not, paying you for the money you are parking with me. I'm charging you for the money you are parking with me. Why am I doing it? Spend. Why should I? To revive the economy. So I am discouraging you from keeping the money in the bank because I want you to spend, because without your purchases, the economy will, decline, the growth rate will decline, or you could even be in negative territory. That is what is called negative. Negative is where for the deposit, the depositor is charged by the bank. Has it happened? Yeah, it happened there. And one more meaning I have given you what example I gave, nominal to real I gave. Yeah, nominal to real. Nominal is 102.75, real is -3. Worked it out. Then I gave you the example of charging for the deposit. Charging, not paying. Charging for the deposit. Commercial bank, State Bank of India. We don't have that. Then there is another mechanism of putting the economy in the zone of negative interest rates, that is, I'm the central bank, you are the commercial banks, guys are depositing money with you. So you are giving them whatever, you're giving them 0, okay, 0 you're giving. Or you're charging them, somebody comes to you with 100 euros, and you are telling him after 1 year, you please come and take your 99 because $1 is the negative interest rate, which is what you call charge. You want to keep the 99 with me. I'm the central bank, you are the commercial banks. Why? You want to earn some interest on that? I find this very, very, undesirable. Why? You have to lend to the economy so that the economy comes up. If you are parking your money with me, what will I do with your money? I just got to give you interest. Safest. This is like the ship in the harbor. Are you a ship in the harbor? Safest. No piracy, no storm, nothing. So, in order to discourage you from depositing the money with the central bank for a certain interest, and not taking the risk of lending into the economy, the central bank charges you for the deposit to discourage you from doing it so that you lend to the economy comes up. That is the central bank policy of negative rates. Central bank. I'm sure you have understood. Is there anything that requires additional explanation? See, generally, when you speak, you have to be understood. Otherwise, don't speak. So, nominal, these are the three meanings of negative rate. We don't have any one of them. And you do it when the economy is crashing and everybody else is doing whatever they can do, government and stuff. And the central bank has to chip in. Chip in with what? Unconventional monetary policy interventions. QE we have seen. Another is the negative rate. This is also unconventional. I could pause here for a minute about the negative rates of interest. Tomorrow, if the question comes in the prelim, you know what is going to ask you? It is said that in a economically difficult situation where the rate of growth is, the economy is going into the negative. One of the policies followed by the central bank is termed non-traditional, which is negative rate, whatever. He will use the word charging. The guy with whom you are depositing your money, parking your money, is charging you as if it's a locker. That is when the signal is clear. You have to, go into the economy and not run away from the economy and park it for all sorts of safety. Charge you, that's the meaning. Yeah, let's get the graphic. Yeah. Quantitative easing. Oh, super. Hyperinflation. We haven't dealt with inflation, so right now I should not. Hyper means there's nothing beyond that. 80%, 100, whatever percent, but overheated economy, properly. Didn't be overheated also, very high levels of inflation. Bubbles, asset bubbles are, see, you bought a Reliance share of, it's 100 rupees. What is the business, what is the management, what is the future? Take every positive factor, every negative factor, cancel out, lot of cash is moving around. So 100 is about the highest, the price of the Reliance share. 1000 it is quoting. It's a bubble. It will have to fall to 100. So asset bubble is, gold should be 100. 2000. There's no rationality there. So when an asset, financial or physical, acquires a price which is disproportionately higher than what it should be, it's called a bubble. Asset bubble, land, gold, stock, bond, they're all currency, they're all assets. Diminishing effects over time. So this is the risk. This is how you come out of the crisis, encourage borrowing, reduce all this, and then effect on interest. Lots and lots of money is there. Interest rates also. I told you interest rates and the liquidity. More money, lower interest. Less money, higher interest. I have only 100 rupees. You want my 100? Give me 10%. I have 500, 8%. 1,000, 6%. 2,000, 4%. 10,000, 2.5%. So, the more the money there is in the market, the less the rate of interest. The less, the more interest. So, overloaded the economy with freshly minted money, so rates have to fall. Lower interest rates. Increase by increasing the money supply. Hyperinflation for the time being, you understand, after all, what will happen? A lot of cash you are dumping into the economy. What will happen? Excess of cash, what will it do? It will only inflate the economy, isn't it? We are all there. We are all disciplined people. But banks are tempting us, take cash, 0%. Ooh, we all take cash, go to the market, and then, you want to buy something there. Is it not? Hyperinflation? No? Is it or not? Yeah. If you don't tell me you have understood, I have to go on and on and on. Yeah. Hyperinflation, technically speaking, I'm not here to talk about it unless as a part of a fully fledged lecture in the inflation chapter, whenever that is. Post Dashara it will be. Quantitative easing. These are negative rates. See, the title is missing. negative interest rates. Wonderfully explained. Please go through. When you were in the 9th and 10th class, you must have dreamt things have to be simple, then I can conquer the world. This is simplicity. The MCQs that we have given yesterday and the day before, you comfortable? Please, please. You have to speak louder.
Which of the following does not require collateral for borrowing and lending? A. Repurchase loans, reverse repo operations, MSF, SDF.
SDF. Obvious. See, repo, reverse repo, MSF, they are all in the same family. You collateralize your government securities, either way. Yeah? SDF is the odd guy out. It's a deposit. Everyone speaks through the loudspeaker that for the SDF, one important convenience is you don't require the collateral government securities, it's cumbersome, etc. Very simple. I hope you got the concept. Yeah, concept is important. A million MCQs will come right if the concept is in place. I love making these MCQs because I want to tickle your brain on the UPSC line. Yeah, Dharmendra ji, this is all. Oh, this I'm coming to right now. I've not discussed. I'm coming to not now, little later. We are still in the unconventional. We haven't come to India yet. You talked of QE. You talked of negative. You also talked about QE negative. Now, the third one should be, we have come to India now. Close to the QE, what we have done in India is government securities acquisition program, GSAP, Government Security Acquisition Program. Listen to me very carefully. Tied up are the questions. See, you're all commercial banks. I'm the RBI. We are in uncharted territory, post-COVID. We have no idea where we are going. Pitch yourself back 2 years today, 23 September. That is the time this one entered into the picture. You're all commercial banks. Government wants to borrow. How much we don't know. Government wants to borrow. As the debt manager of the government, RBI has to manage the debt, bring the money. I don't want to print. Printing is the last resort. So you guys have you are the commercial banks. You got the deposits. And the other money also, equities and debts, and you got the money. I'm the RBI. You are the commercial banks. This is the government. And they're calling me 100 times a day. Where is? So what do? I sold you long-term securities. 10-year, 5-year, 5-year, 10-year. I sold you. Take this paper, give me the money. You gave me the money. Pass it on. But you bought a little more than you otherwise would. People's money. You bought the paper. You know, even zero risk government security, you develop doubts if more is borrowed than what your good sense tells you about the government's ability to repay. Here is the government of India, $3.5 trillion worth of economy. Tax collection is about, you know, a lot of 10, 11, whatever percent of GDP. Anyone can lend money to the government of India. So we have a lot of faith in government. So we bought securities. But they want us to buy even more security. Will they repay? If they don't repay, banks will go bankrupt. So after a while, you guys got a doubt. RBI sold, we bought a lot of it already. But then you are not in a mood to buy more because you can't sell the security to somebody. This security, 1,000 rupees, government has to give you 1,000 and the interest. This security. Up to a point, the government is credible, zero risk. But then you bought, up to here there is no risk. You added more, you know, this is 10, this is 2. And then the RBI told you, buy this also. So you've got 10 here, you've got an extra, you know, 2 rupees or 3 rupees. And then, you know, RBI wants you to buy. Sorry, people's money, anyone in the field of finance will have. Then the RBI told you, you don't worry. You buy the paper. If there is no market for it, I will print money and buy the paper from you. You won't lose. I'm the RBI, that's the government, and you are working in India. That is called the Government Security Acquisition Program. Buy the government security number 1. As much as we sell you number 2, don't worry about its liquidity number 3. I'm going to buy it number 4. What are you worried about number 5? So that is the, you know, generally the central bank doesn't reveal the aces, you know, it's going to play. It is very tight-lipped. But when I want you to behave in a certain manner, I need to build your confidence, for which I have to reveal the future actions of the RBI well in time so that you will act accordingly. So this government security acquisition program of the RBI, where a lot of money is printed to acquire the government securities with the banks and others, is compared with the QE of the American Federal Reserve, because here also a lot of money is printed and it is put into the economy to buy government securities. The additionality about the American QE is they bought the junk paper also. Now we don't touch the junk paper, government security. But you are telling them, normally they buy this much. You are almost asking them to, you know, double whatever, much more. So they developed nervousness. RBI pacified them, you don't worry. I'm assuring you, here is my GSAP. You know, tens of thousands worth of crores I'm going to buy. So that is also unconventional, that RBI prints and buys its own securities to a level where it is done entirely to feed the government. You are the banks, that is the economy, you have to lend money. So, you know, more than last year, 5 rupees I will print. Here, how much I have printed? Entirely to, you know, give it to the government. So that is GSAP, Government Securities Acquisition Program. It is tied to another thing called Operation Twist. You know, the prelim level is not going up. Horizontally, it's widening. Horizontally. Level is not going up. Level is the same level. Coverage is more. operation twist. Twist means change. Now I am coming into the yields and bonds and all that. Listen to me. Twice the question came. It will keep coming. See, so there is government, and the government wants the RBI go borrow and then pass it on to me, my fiscal deficit. So there are bills. For 1 day to 364 days bill. This is money market. Bond 365, eternity, perpetual. In India, first time we are going to issue a bond for 40 years. That can come in the prelim. So far we confined it to 30 years. 40 thing is coming up. The other day, Hindu covered. I think Hindu covered, yeah. So, government issues short term, less than 1 year, medium term, that is bond, more than 1 year. So, there is a bond. Bond is okay, government security bond, whatever. I'll generally bond. Government security. Its face value is 100. That is, the value of the bond is 100. And interest will be, let's say, 7%. So here is the bond, you take it, give me the 100. Interest is 7. After 1 year, interest is 7. Very simple, interest is 7. So 100 rupee bond, face value is 100, interest rate is 7. I give you 100, I'll give you the bond, you give me the 100, 7. This is for, let's say, 6-month thing, or 182 days or whatever, short term. Another bond is there. I'm using the bond term very simply, bill, bond, etc. Bond. Another thing is there, 5 years, 10 years. Here is the bond, 10-year bond. And you give me 100 face value. Interest will be 8%. Here it may not be 7, could be less, could be little less. Short term 7, long term 8. Both face value is 100. Interest rate, short term is less, long term is more. Why? See, short term is, what will I do with your money? You're keeping it for 6 months, etc. Number one. What are the risks? You know all the risks. Where are the risks? None. There's no risk, number one. Locked in for a short period, number two. Can't be used for, long-term lending, etc. Number three. So, I will give you less. Long term, you're locking for 5 years, 10 years. Who knows how many Gazas will come in between? What will happen to the world? I'm risking investing in this bond. So, you give me more. The higher the risk, the more the interest. The lower the risk, the less. So, short term fetches you less. Long term fetches you more interest. That is the normal logic. That is the interest rate. But I'll explain to you yield now. Yield is very interesting. What is yield? See, 100 rupee bond I have fetches me 7. I have sold it for 90. Why did I sell? Gaza, inflation, interest rates will go up. It's fetching me only 7. Tomorrow it will fetch me 8. Uncertainty. So the 7th thing I'll sell off. 100 rupee bond I'll sell for 95. 90 I'll say 90. Only for simplicity, not for 100 thing I'll sell at 90. So 100 was yielding me 7. This guy bought this 100 bond at 90. So the 7 becomes 7 plus because to get 7 you have to invest 100. He is investing only 90 but getting 7. Which means he is getting about 8.5 or 9%. He is putting 90, he should have put 100, but he is getting the full value of 100 even while he put 10 rupees less at 90. So the yield is more, 9% is getting 9, 8.5 is getting. Yield is more. Or put it the other way, there is a lot of demand for government bonds. Economy is doing wonderfully. Rates are going down. There is demand for this 100 bond yielding 7. Somebody is ready to buy it at 102, 103, which means 7 on 100. He is getting 7 on 103. He is getting less than 7. So the greater the demand for the bond, the less the yield. The less the demand for the bond, the more the yield. Is it clear? Yeah? Clear now? Okay. So that is the yield logic. The price and the yield are inverse. The lower the price, higher the yield. The more the demand, the lower the yield. The higher the price, the higher the price, the lower the yield. So you get the equation between yield, price, yield, demand. Obviously, if there is more demand, you got my bond is there and everyone wants my bond, and so, you want to buy, which means you got the money, I got the paper. So what do I ask you? I'll give you 2%. If there is no demand, come, I'll give you 4, you give me the money. Lot of demand, I'll not give you. Lot of demand, I'll give you only 2%. So the more the demand, the less the interest rate. The lower the price, the face value sold off, the lower the demand, the higher the yield. So you get the words here. Demand, price, yield. Among these 5, you can make, lots of combinations. Now, generally what happens is, as I told you, for the short-term securities, interest is low, long interest is more for the reasons I have told you. But you know something that happened last year? These guys who are just like you guys are studying all the time. UPSC, this question came, oh, he's asking. Just like you have mind made only for UPSC, the guys in the bond market, they have mind only for bond, interest, price, inflation. Their whole mind is that. So they are watching the yields. Short-term yield, interest rates. Short-term rates are going up. Long-term rates are going down. What the hell is going? Short-term rates used to be 2-3%. Now people want 5% to buy the bond. That is, the demand for the bond has fallen. Long-term used to fetch you 7. Now people are saying, okay, even if you 6, it's okay because there is demand for long-term. So the yield got inverted. The graph was like this. This is short, this is long. Short is giving you less, long is giving you more. The inversion is this. Short is giving you more, long is giving you less. That means your confidence about the economy in the long term is good. In the short term, it's not good. That is a recession. Recession, tumbling down, and then, the demand for bonds will go down in the short term. When the demand goes down, ask is more. Long term, though, we will bounce back. There is no issue at all. So long term, you give me less. Short term, you give me more, which is the opposite of what normally happens. This is called the inverted yield curve. Everything you see, basically the RBI people, right to the top. Magnifying lens, the curve, the curve, the curve. How much is it yielding? How much is it yielding? What is the curve? You know, their magnifying glass will be, they can see on a weekly basis, fortnightly basis. So if the curve is showing inversion, it is 100% clear. The market expects a recession. Long-term confidence, short-term collapse of confidence. That's what the yield curve is showing. Now this was happening in India also, and RBI had to take some action. So what action did the RBI take? Oh, you guys are selling off the long, you're not confident? You're lapping up the short? So I'll do the twist. Twist means change. You know, this is not a healthy thing. If the short is yielding X, maximum the long can yield X plus 1 or 2. Can't be like this. In an economy, short, medium and long, there should be confidence. If the yield curve is showing that the long people are confident, short they are not, or vice versa, then you have to step in and stabilize the curve, the yield curve. So guys are selling off the long because they are not confident. At one time, not now, not during the recession. So RBI said, you don't worry, I'll do the operation twist. I will sell the short bonds, there is demand, I'll get the money, I'll buy the long. You guys are not confident about the long, I'm here to buy you. And the short bonds I'm selling, there's tremendous demand. Before recession, not recession, normal, not recession, normal. Short there is demand, sell short, get the money, buy long. So earlier, short lot of demand is there and rates were low. Lot of demand is there. People love my bond. So what do? I'll give you 2%. Long, 6%. But this is unhealthy. So, supply more of short and, more supply means less demand relatively. So, even if you're starting here, long will be here. This is long, this is short. This is short, this is long. Look at the gap here, look at the gap here. So, the gap in the yields between short and long has to be stabilized. Operation twist is this. Sell short, there is demand. Supply short-term bonds, bills, whatever. And sell them, guys are there, demand, take the money. Give me the money. I'll buy the long. So your confidence in long is back. And short, you never short of confidence. That is how RBI's GSAP helped in stabilizing the yield curve, number one, by infusing confidence on the long bonds, number two. And of course, unconventional. You have to do it, otherwise panic spreads. When it spreads, you can't call it back. I hope you understood. This was one more. And there are two more about the unconventional monetary policy in India. Two more. One is, all of them are potential entries. LTRO. Long-term repo operations. See, remember one thing. RBI has only one job. Those days, post-COVID. Give money to the market and make them incentivized to lend. Small guys, MSMEs were not doing well. Some others not doing well. Nobody expected the viral economy to, swallow them. So RBI's job is make the banks lend. How? You're all commercial banks. I'm the RBI. If I ask you to take the money, normally, you're not inclined. After all, it's a virus economy. You are asking us to take the risk. No, we don't. Then the RBI innovated. You know what it did? RBI told you guys, if you are ready to lend to these guys, MSMEs and others, take money at today's rate, repo rate, 4%. Today's rate, take it for 3 years. And my rate may go up anywhere. After all, it can only go up. It can't come down. 4 is the bottom. So take at 4 for 3 years. I'll charge you only 4 for the next 3 years. Today 6.5. You borrow, you have to pay 6.5. The guys who borrowed at 4, 2 years back, are still paying 4% on those loans, provided they lent to certain sectors. Did the sectors carry risk? That they'll work out. So this is long-term repo rate, borrow at current rate, which is very low, the lowest you can ever entertain, and the rate for you will be the same for the next 3 years. So others are paying 6.5, you are paying only 4. So that's a proper abundant incentive for you to go out and lend and therefore do it. That's how the economy can be brought back. Long-term repo rate. And then there was one more thing about the unconventional, one more thing, which is, you know, I told you, central bank, when it presents its monetary policy, credit policy, it does not reveal anything about the future. It may broadly say something, but generally doesn't reveal anything. Why? After all, the monetary policy is about money. If I say my policy stance is this, I'm going to up the rate or down the rate or whatever, all that. Based on that, lakhs of crores of rupees of speculation will take place. Therefore, the topmost secrecy is the norm for the monetary policy. But then I want to influence your behavior. This is COVID. If you're not confident, I'll make you confident. If you're overconfident, I'll bring your confidence down. I have to do all that. So what do I tell you? Forward guidance. Whenever the RBI presents its policy, it will clearly, it told them, 1 lakh crores of rupees worth of long-term bonds I'm going to buy. Nobody reveals the future actions like this in the monetary policy domain. We've never seen it. But when times are different, your policy also has to be different. So RBI used to say, I'm going to buy, I'm going to be expansionary, oh, this, that, all that. I'm going to show you. In monetary policy, this is forward guidance. Monetary policy, unheard of. Now, the norm. Not anymore, maybe, but during the COVID crisis, unconventional, non-traditional. Expansionary means lower the rate, lower the ratios, make more money available. That is expansionary. Contractionary is the opposite. Raise the rate, raise the ratios, contract the money supply. And if the expansionary policy is just about beginning, you call it accommodative. You are neither expansionary nor contractionary, neutral. You are hyper-contractionary, tight. You call it tight. And the two birds that you refer to them, hawk and the dove. Hawk is you contract the money supply to kill inflation. Dove is you expand the money supply to accommodate growth. Even while inflation is a problem, your primary goal is to enable growth. And all this, I'm going to show you the graphics. Dharmendra ji, we have a lot of animals. Yield curve, yeah, please, I think you have to see. Nobody is going to ask you what is the yield curve inversion. No, this is 10th class exam. But each concept can be brought into play in a non-technical language. He can ask you, the demand for short-term bonds is high, the demand for long, all for how many statements are correct? Not which ones, how many are correct? You are made into a gambler. How many are correct? What is it? How many are correct? Which ones are correct? Then your conceptual knowledge is being tested. Factual knowledge is being tested. Yeah. Yeah? Zoom. Dharmendra sir. That's what I told you. Yield means what? See, the interest on paper is also yield. When it is sold at subpar, yield is more. Sold superpar, yield is less. But the yield is interest basically. Link, isn't it? Yeah. He's watching every word. Wonderful. Super. Yes. I am ready to increase also. See, whatever it takes, I'll do. It can be from the given quantum of money, if I am doing it, it is quantitative. It is qualitative. I am expanding the balance sheet. Qualitative. I mean, qualitative, don't expand. Quantitative, expand. I am ready to do whatever it takes. You know, we are in emergency, we are in a crisis, so I'm not adjusting with the cash available. I'm expanding the balance sheet. How much do you want? Take it. This is done? There's no hurry. Next is twist. Operation twist. RBI did it. Somewhere here you get the Reserve Bank. But because the Fed did it first, American Federal Reserve, you get the name of the Fed somewhere here. But I made it a point that we should talk of only the RBI. Who is bothered about American Fed, you please tell me. I'm bothered about RBI, what RBI does. All of them are linkable. Twist is change. Short, long. Change it to, shorts yield a little more, longs yield a little less. Change the demand structure, yield structure. Reserve Bank did it even before COVID struck, but during the COVID they did more. Even before the COVID struck, our growth was going down, for God's sake. So RBI had to do something about it. Yeah. Yield curve. Inverted, yeah. Short term, supply is more than the demand, therefore the, more I want to sell. Originally, I said, I'll give you only 2%. You said, okay, the demand is very high. But when the supply goes up, the rates also I have to offer you 2.5, 2.75, etc. The more the supply in relation to a certain demand, rates also go up because demand is constant, supply is more, is it not? Yes, which is the opposite of the normal, short demand curve.
So the situation is that during short term, you offer more interest, and during long term, you offer less interest. Is this the situation?
In the twist. Yeah.
In the inverted yield curve.
Normal, the short is less and long is more. Even now, short is less than long, but short is more than the normal short. Got it, no?
Yes, sir.
Yeah. You got your answer?
Yes, sir.
Yeah, if I knew your question very clearly, I can pinpoint the answer. Unless you already got your answer.
Sir, I just got confused in the twist and the...
You revised it?
Yes, sir.
Okay. This is twist. Not this. GSAP. Okay, GSAP, please. Take it slightly higher so that they can see Sriram Sir. You just have to revise for 1 hour, come back for another 1 hour or 1 hour and a half, then it's your intellectual property. In the meanwhile, I'll be also giving you FAQs when the news items come. That is a deadly occasion for you to revise. You know this, you got the book, and the Hindu, in a month or two, whenever they are going to meet in December, in the meanwhile something happens. I'll make it a point that elementary knowledge is imparted and your revisions are taken care of. Anything else also? Oh, please. Oh, that's the level of interest I love. He said, okay. You said, okay? One or two more also I remember making. No, RBI we have not. Narrow, broad, no, we have not. Oh, bring back that yesterday's Hawk and Dow. And also monetary policy stances that I sent the latest. Yesterday the Hawk and Dow. And today the last one I sent you was the stances. Oh, here are the birds. See? Hawk. There are no doves in the world anymore. They have only hawks. Huh? Yeah, but only on the board. Real world. I told you, Hawk is the contractionary guy. Dow is the expansionary guy. And you will get that in the next graphic. The latest that you got, Dharmendra ji. Monetary policy stances. Stances. The last one that you got. Oh, expansionary, contractionary, neutral, accommodative, tight. Our governor also introduced one more, withdrawal of the accommodative. See, I'm ready to accommodate your demand for money, by tweaking the rate or whatever. I'm ready to accommodate. That means towards the expansionary. He didn't say I'm neutral or something. What he said is I'm withdrawing the accommodative stance. I'm no more accommodative. I'm not saying I'm contracting. I'm not saying I'm neutral. I'm saying nothing. Withdrawal of accommodative. I won't accommodate your demand for money. So that is another nuance that he created some time back. Hypercontractionary would be tight, very aggressive. How much time do I? Oh. Same thing that I told you, nothing more. And the last one is our current thing. You know, yesterday the Hindu almost had nothing to read. Today, yeah. I thought this is a terrific, terrific thing for you. I'm going to explain when my time comes, maybe in a month or so. And this, for a cursory reading, earthquakes is geography, Catalonia is dead, global growth, you know, what we are contributing, it will take you 10 minutes. I have simplified it hyper. And this, you know, it's a draft policy. Let's see where it goes. Food security, study it for half an hour, but I've made it very simple. Northeast monsoon, geography. I thought this is a terrific thing. Leave the whole thing to me. I'm going to discuss that. Leave the whole thing to me. I'm going to discuss. Keep those two clips with you. Read it if you like. Don't read it if you like. When my lecture time comes, I'm going to make it very clear to you. So to read or not to read is entirely your choice. But holding me accountable, you have no choice. So that's the Hindu. We are meeting tomorrow.